Right now, something big is shifting in the US financial system, and most people won't notice it until it hits their bank account. Inflation didn't just raise prices, it changed how money is tracked, how income is reported, and how closely everyday transactions are looked at. And here's the part that matters for investors. When governments deal with rising costs and massive obligations, the system doesn't stop, it adjusts. That adjustment shows up through tax rules, reporting requirements, and enforcement. Not overnight headlines, but slowly, quietly, consistently. If you're an employee, a small business owner, a freelancer, or someone investing on the side, this affects how you save, how you invest, and how you plan. This is not about fear. This is about awareness. Because smart investors don't argue with the system, they understand it. They structure their money properly, and they move in ways that stay compliant while staying ahead. In this video, we're going to talk about what's changing in the tax environment, why passive investing and documentation matter more than ever, and how real investors adjust their strategy during inflationary periods, without panic, without shortcuts, and without doing anything illegal. If you want to build wealth in today's market, you don't just need returns, you need structure. Stay with me. The first thing smart investors do in times like this, they stop reacting and they start structuring. Because when inflation rises and tax systems tighten, the biggest mistake isn't losing money in the market. It's running your finances without a system. So here's the first real move. Separate your income from your investing and automate the process. Most people wait to feel confident before investing. That's backwards. What experienced investors do instead is simple and boring. And that's exactly why it works. They decide in advance how much money gets invested every time income comes in, no matter what the market is doing, no matter what the headlines say. This is called passive automatic investing. And in the current environment, it's not optional, it's protective. When money moves automatically into investments, you reduce emotional mistakes, you create consistency, and you build a paper trail that matters for taxes and compliance. Now here's where people get this wrong. They think passive investing means set it and forget it. It doesn't. It means controlled consistency. You choose diversified assets like broad market funds, long-term stock exposure, measured exposure to alternatives like crypto, and inflation hedges such as physical gold or gold-backed assets, and you invest a fixed amount regularly. Not because the market is perfect, but because timing the market almost never beats discipline. At the same time, you keep cash reserves. Real investors always keep liquidity. Not for shopping, not for lifestyle upgrades, but for problems and opportunities. Cash protects you when something goes wrong, and it gives you flexibility when something goes right. Now let's talk about the tax side, because this is where things have changed. In today's environment, what matters isn't just how much you make, it's how well your income and investments are documented. Side income, freelance money, small business revenue. This is where people get careless. Smart investors document everything properly, track income clearly, and work with professionals who do more than just file forms. Because filing taxes is not the same as tax planning. A tax planner looks at your income structure before the year ends, not after the damage is done. They help you understand deductions, timing strategies, and legal ways to reduce unnecessary tax exposure, especially if you're investing while earning. And here's an important mindset shift. Paying for good advice isn't an expense, it's risk management. Cheap advice often costs the most later. So part 1 is about building a foundation, automated investing, clear separation between spending and investing, proper cash reserves, and proactive tax planning. Not panic moves, not shortcuts, and not hiding income. This is how investors stay calm while everyone else feels squeezed. After setting up a strong foundation, the next move smart investors make is knowing when not to act. Because in markets like this, doing nothing is often a strategic decision, not a mistake. When inflation is elevated, interest rates move higher, and tax oversight becomes tighter. prices don't always reflect real value, and experienced investors understand one key rule. Opportunity doesn't disappear. It waits. So instead of rushing into every headline-driven move, investors become selective. They stop chasing hype. They stop forcing deals. And they shift their focus to pricing, cash flow, and structure. Let's start with real estate, because this is where many people get emotional. In uncertain markets, smart investors don't ask, is real estate good or bad right now? They ask, does this deal make sense at this price, with this financing and this cash flow? If interest rates are high, payments matter more than appreciation. So investors run conservative numbers, stress test cash flow, and walk away if the deal only works in a perfect scenario. There is no desperation buying. If the math doesn't work today, they keep cash ready for tomorrow. Now shift to stocks. Instead of aggressive trading, investors lean toward broad exposure and quality assets. They avoid overreacting to short-term volatility and focus on companies or funds that can survive tighter conditions. This isn't about predicting the bottom. It's about owning assets that can operate under pressure. They continue passive investing, but active buying becomes patient and intentional. Now let's talk about alternative assets, like crypto and gold. In this environment, investors don't bet their future on speculation. Crypto exposure is measured, documented, and treated as a long-term asymmetric position, not quick money. And gold or gold-backed assets serve a different purpose altogether. They're not about returns. They're about stability and diversification when currencies lose purchasing power. Now here's a critical tax-aware move most people miss. As investors slow down active buying, they increase organization and documentation. Every transaction is tracked. Every investment is categorized. Every income stream is clearly defined. Because in a tighter system, clean records are protection. This is also when smart investors lean into professional guidance, not because they're confused, but because complexity has increased. Markets change. Rules evolve. And strategy needs updating. Instead of guessing, they adjust with information. So part 2 is about restraint and readiness. Slowing down active moves, raising standards for deals, keeping capital flexible, and making sure every financial move can be explained, supported, and defended. That's how investors survive tightening cycles and position themselves for the next expansion. When markets tighten and rules evolve, short-term thinking becomes expensive, but long-term positioning becomes powerful. This is where smart investors quietly pull ahead. Because while most people are focused on headlines, experienced investors focus on systems. The first system they build is predictability. They don't rely on guessing where markets go next. They rely on repeatable processes. Income comes in, a fixed portion moves into investments, records are updated, and decisions are reviewed on a schedule, monthly, not emotionally. That rhythm alone eliminates most costly mistakes. Now here's where long-term investors separate themselves even further. They invest beyond assets. They invest in infrastructure. That might mean better bookkeeping, stronger tax guidance, or tools that make tracking income and expenses automatic. Because in a more regulated and transparent environment, clean systems reduce risk and stress. And when complexity increases, clarity becomes a competitive advantage. Next comes business and skill-based investing. In times like this, many investors redirect a portion of capital into themselves, building a business, improving cash flow, or acquiring high-value skills. Why? Because businesses create flexibility. They allow income timing, expense deductions, and long-term scalability, all while staying compliant. This doesn't mean quitting your job overnight. It means creating optional income, documented properly, structured cleanly, and aligned with your investing strategy. Another key long-term move is relationship investing. Smart investors build relationships with professionals, accountants who advise, not just file, bankers who understand cash flow, and partners who think in years, not weeks. These relationships don't show up on a balance sheet, but they quietly protect it. And here's a mindset shift that matters now more than ever. Wealth isn't built by avoiding taxes. It's built by planning for them. Investors who stay ahead don't hide income. They structure it. They understand how timing, documentation, and legal strategies work together, and they update those strategies as rules change. This is how confidence replaces anxiety. Because when you know your numbers, when your systems are clean, and when your strategy is intentional, uncertainty stops feeling threatening. It becomes navigable. If this conversation helped you think differently about money, don't let it stay as information. Start small, but start structured. Automate one investment. Organize one income stream. Review your numbers once a month, not once a year. And most importantly, keep learning how the system works so you can move with it, not against it. Because in today's market, the biggest advantage isn't speed, it's preparation.